So we're live now. Hello, everyone. Good evening. Hope you all are doing well. Thank you so much for taking out the time to join us for our monthly Rebalance AMA webinar. It's always great to see people joining in. We'll just wait for a couple of minutes to see more people joining in. So stay tuned. There have already questions coming in the chat box. That's great to see as well. So my name is Simran. I am part of the marketing and business development team at Gulaq, and I'll be your host for the session. And of course, we've got Vivek Sharma with us, our investments head here at Gulaq. Many of you already know him from our previous sessions, but for anyone new, Vivek has been in the investing world for over 20 years now and manages the team at Gulaq that builds our strategies. So just to give you a brief about what we have stored in today's session for you all, like every month, this session is all about transparency. So giving you a clear look at what's changed in the portfolio and how everything has been performing. We know investing can sometimes feel like a black box. So the idea here is to open that up and keep things simple and honest for all of you. We've had a bunch of great questions coming through the Google form already. So thank you to everyone who sent those in. And if you didn't get a chance, no worries. You can drop your questions in the chat anytime and we'll pick them up during the Q&A towards the end. Okay, let's start with the presentation. So just to give you a bit of background about Estee and Gulaq, Estee has actually been around for quite a while. We started back in 2008, right when SEBI introduced algo trading in India. The core idea was simple: use data and technology to take out emotion out of the investing. For most of our journey, we were focused on institutional and high net worth clients through our portfolio management services. That's where a lot of the research and strategy development happened for us. But over the time, we started thinking that why should systematic investing only be for the wealthy? So that's why we built Gulaq. So it's our way of making the same data-driven, research-backed strategies available to everyone and not just the HNIs. With Gulaq, you don't need rupees 50 lakhs to get started. You can begin with as little as a few thousands via small case or pick right our technology platforms. And what you're getting is the same philosophy, the same approach, just it's more accessible to everyone. We've had over 25,000 investors use our Gulaq portfolios in the last few years, and we would be soon completing 5-year milestone as well since we were live on small case. Moving on to the next slide, a quick shout out to our team as well. Sandeep Tyagi is the founder and CEO and has been the driving force behind ST. He is an IIT Delhi and Columbia Business School graduate with 30 years of experience in finance and analytics. And of course, Vivek, who you'll hear from shortly as well, has a background in engineering from IIT Kharagpur and brings decades of market experience to the table. Whereas for me, I work as an assistant manager in business development and marketing team at Gulaq. I've done my bachelor's in economics from Miranda House, University of Delhi, and have been part of the Gulaq team for 3 years now. So along with everyone at ST, we have a simple goal, which is helping investors cut out the noise and make smarter decisions using data. Okay, so this slide is a quick compliance note to all our investors. As a SEBI registered investment advisor, we are required to remind you all that investments carry some level of risk. So we should read all relevant documents before investing and remember that any securities mentioned today are just for information purposes and not buy or sell recommendations. Feel free to pause here if you want to have a look at these disclosures more properly. All right, now to the main reason that you're here. Vivek's going to take us through this month's rebalance, what's new, what's moved, and what it means for your portfolios. So, Vivek, over to you.
Thank you, Simran, and welcome everyone. So I'll first take everyone through our portfolios, right? So our Gulaq portfolios, these are segregated into different gears based on the risk appetite of an investor. So a gear 6 has 100% equity, and because equity is the most volatile, obviously it gives the highest returns also. But because it's most volatile, it is meant for very aggressive investors. Gear 5, which has 80% equity and 20% debt, is slightly lesser volatile than Gear 6, and this is meant for more moderate to aggressive investors. Gear 4, again, 20% debt addition to Gear 5, so overall 60% into equity, 40% into debt, and these are meant for moderate investors, and whereas conservative investors can look at gear 3 as well, which has 40% equity and 60% debt. Now all of these gears are available through small case platform itself. Now talking about gear 6, changes in gear 6 from April to May. Now we see that our large cap allocation is down by about 12% from 37 to 25%. Mid cap is roughly around 40% itself, whereas small case has gone up by about 15%. Now, talking about the sectoral bets, we have increased our allocation to healthcare, financials, and a bit to energy as well, and reduced our overall allocation from utilities, consumer staples, and industrials. Right. This is a month-on-month comparison, but you should also compare what's the sector weight in BSE 500 is as compared to what is it for us. So if you see, healthcare has just about 6.4% allocation in BSE 500, whereas we have given healthcare 40%. So we are quite bullish on healthcare as a sector for this month. Financials, now we are kind of at similar allocation which is there in BSE 500, because now obviously financials has been underrepresented in our portfolios because it was not moving. Last couple of months it has just started moving now, and that's why overall the weights have also now increased. And if you see other big sectors like IT, which we have zero allocation, materials we have zero allocation, and even consumer discretionary, we are quite underweight. If you look at industrials also, and that's another big sector where at least in this month we do not have any stock from this specific sector. Now talking about weightages to these factors, this is quality pretty much is one which we are betting on this month, as well as value. And I think a lot of financials also are getting picked up because of this very high weightage to value this month, and the rest three, volatility, momentum, and leverage, they remain zero. The big change is that leverage, we were giving some weightage to leverage, which is a kind of quality indicator only. This is now down to zero. So overall, our stocks are being picked because of quality and because of value. Now, if you look at Gear 6 performance, it's been now 5 years. So in these 5 years, we have produced very healthy alpha of about 21%. Last 1 year has been a bit of a struggle for us. So out of 5 years, 3 years we have done very well, produced huge returns. 1 year was kind of break even, and 1 year was bad. I think this is to be expected also over long run, that we or any active fund, it's very hard to beat the benchmark year after year. So this is where we stand. Obviously, things looks like it has started turning around. Last month we have generated some alpha, but it's still too early. Gear 5, again, the benchmark here, the difference is the benchmark here is a synthetic benchmark which we have created to measure the performance of Gear 5, because Gear 5 cannot be directly compared with Nifty or BSE 500 indices, because those indices have 100% equity allocation, whereas Gear 5 has just 80% equity allocation. So we have constructed synthetic benchmarks in which we have given 80% weightage to BSE 500 and 20% to FD, and that's how we have created these benchmarks. So similar trend. Last 1 year we have underperformed, but overall, if you see over last 5 years, we have produced significant alpha. So almost 50% higher returns than that of benchmark here. Same is the case with Gear 4. Gear 4, the extent of underperformance is very low because we have about 40% allocated to debt here, which has been producing, and that's why last 1 year the extent of underperformance is uh, close to zero itself. But overall, if you see since our launch, even this portfolio has generated pretty good returns. And this is with Gear 3 performance. Yeah. So this is overall the performance of these 4 gear-based portfolios as compared to that of Nifty Multi-Cap Index. So as I was telling you, out of these 5 years, actually these are 5 years, but if you see in terms of calendar years, there'll be 6. So these first 4 years, calendar year 2020 actually did not start from January, it started from May. But overall, these 4 years, we have produced pretty healthy alpha. Last year, we were break even, and this year, we are slightly down. So as of April end, we have given a negative return of about 3.5% here in this year. So we also launched a couple of market cap based portfolios. These were launched in December because a lot of our investors wanted to take market cap based bets, and that's why we launched these portfolios. Large cap portfolios, it's been what about maybe 5 to 6 months. This has underperformed significantly in last 6 months. About 10% is the underperformance here. But our expectation, if you look at the longer term expectations based on the back test, obviously back test, we can only give so much weightage to back test, but this gives us some indication of what to expect maybe over long run. Yeah. Gulaq mid cap, again, the extent there's some underperformance there, about 3.5% in last 6 months. Overall, over longer duration, we expect about 8 to 10% of alpha in this based on the backtesting. Again, these backtests, we have taken into account a transaction cost, slippages, DP charges on a portfolio of 1 lakh rupees. And this is the small cap portfolio. Again, here we have some bit of underperformance in the last 6 months. And below, we have given the backtested returns for this over last 10 years. Okay, so we got few questions. I'm going to take these questions first of all, and then we'll be happy to take the other questions that we are getting right now. So one of the questions is, why do I receive my update alerts a day late? This delay started 6 months ago and consistently causes me losses. Tej. So yeah, this is really surprising because our team, all of us, have also invested in gear-based portfolios. We receive our rebalancing updates on time. This is through WhatsApp and through emailers, and this is directly sent by a small case platform. So this is a bit of surprise for us that you are not receiving your rebalancing alerts on time. So please allow us few days. We'll definitely check this with small case team as to what is causing this delay, and we'll get back to you on this. Ideally, this should not be happening, but we'll definitely check with the small case platform and we'll get back to you on this. Tasleem is asking, does your algorithm review both data and fundamentals, and is it updated regularly to reflect changing market conditions? So yes, when we say data, I think what you mean is the technical data and the fundamentals data. But fundamental also, the data is available as to what kind of results a company is declaring every quarter. So fundamental data is primarily that, whereas there's a lot of technical data that we take into account. So we do take into account fundamentals, technicals, and we also do take into account the macroeconomic factors, because that also can be represented in terms of numbers and then be analyzed by our algorithms. So we do take into account everything. This data is updated at the end of every month, and that's when we rebalance our portfolios. And at the same time, our research team keeps on working on how can we improve our algorithms based on the new learnings that we are getting from the markets. So all of this is happening constantly, and our portfolios are being updated quite regularly. Yeah. Tej is asking, should I start using stop losses? I'm considering setting them at 5%. So Tej, this is something that we have tried at our end, that if we use stop losses, how would our portfolio performance be? So this is something that we have spent a lot of time on. Unfortunately, the results there is that this does not really add to the overall performance. Now, there might be times, there might be few months or even quarters where doing such a thing might be helpful, but our algorithms are designed in a way so as to optimize the longer term performance, right? And overall, sometimes they might help us, but sometimes they might work against us also, right? So if we use these stop losses, we get stopped out of a position, and many times then the stock starts recovering from there, and then we'll miss out on the upside as well. So these kind of rules, they cut both ways, and they can only be used if they add value over long run. And as I told you, this specific rule of having specific stop losses in place really does not help the portfolio performance. So we have tried this out. It really won't help you in the long run. There might be few instances where you might save some money, but there'll be few instances where you would miss out on the upside as well. Yeah. Ajay Tomar is asking, I want to build a core multi-cap portfolio that's more diversified than Gulaq Gear 6. Is it sensible to invest equally across Gulaq small, mid, and large cap small cases with a total capital of 30 lakhs? So, Ajay, if you do this, I think this is a fairly good way to diversify. However, your performance would be, if you invest in all three and you compare it to Gear 6, your performance would be slightly lower than that of Gear 6. And the reason is, in Gear 6, we are following a flexi cap approach. So if we find, say, more opportunities in small cap as compared to large cap currently, we will shift our allocation there on a monthly basis. Whereas when you have invested, you have just invested equally in these three portfolios, right? So these three portfolios individually would outperform their benchmarks. But as a group, I think uh, if you want to invest in all three, if you want to take a specific bet, let's say on large cap or on small cap, then these portfolios are meant for you. But if you want to invest in all the caps and develop a multi-cap portfolio, then Gulaq Gear 6 would be the best bet. However, you have mentioned a total capital of 30 lakhs. This is fairly close to what we manage in PMS. In PMS, we manage minimum ticket size of 50 lakhs, but there, the level of diversification that you are talking about is there. So in PMS, we have, it's a fairly, because the capital is larger, we are able to provide that kind of diversification in PMS, and also in PMS, we execute also. So you would not be responsible for execution. We'll take that responsibility, and we have our own very high frequency execution algorithms, which tries to minimize the slippages that we face during the small case rebalancing. Yeah. So if you want, you can definitely get in touch with us. Please go to gulaq.com. There's a page on PMS, and You can have a look at those details of the PMS, and if need be, you can get in touch with our team. Given the current conditions and Gulaq Gear 6 performance, should I continue my SIP, pause them, or make a lump sum investment now? So, Rishabh, this is something we discussed last month also, but I'm happy to take you and others through what are my views on SIP. So, I've prepared a few slides here. Please allow me to take everyone through this. So, Sensex overall has given huge returns. Sensex or Nifty equities have given over last 20, 30 years, huge returns. However, if you see the drawdowns are from the peak, how much you lost in Sensex. This is that chart. So if you see a 40% correction, we have seen about 3 times. So the average is every 10 years, you see a 40% correction. Now, mind you, in March 2020, it's not showing a 40% correction because this is the month end chart. And by the time month closed, by the time March ended, it recovered fair bit of losses and it ended at about 28% loss. That's why it's not getting reflected here. But during the month, there was definitely more than 40% losses even in March 2020. But here the point is that every 10 years you will see a correction which is fairly significant where you will see 40 to 50% of overall drawdowns from the peak. Uh, your 20% correction, the kind of correction that we are currently seeing, happens every 5 years, and 10% correction happens every maybe 2 to 3 years. So these corrections are fairly common, and I wanted to maybe take you through the longest correction that has happened. So this happened from August 94 till August 99. This was about 5 years, 61 months to be exact, where markets did not produce any returns and it was exactly flat for these 61 months. Now, our aim was to see in this longish uh, bear market, if someone were to do SIP and continue doing SIP, how would his returns look? Because overall, from point to point, these returns are exactly zero for 61 months. Okay, so what we did was we took a monthly SIP of 10,000 rupees. So total investment amount was 6.1 lakhs over 61 months. Total Sensex returns during these 61 months was zero, but the total portfolio value increased from 6.1 lakhs to 8.5 lakhs. So you actually saw by doing SIP during this time a total gain of about 2.4 lakh rupees. Here, keep you, just to remind you here, the average unit price that one would have invested would have been at 3514. Now let's look at the chart, right? This was a chart during those 5 years. The blue line is the Sensex at the end of every month, right? If one were to invest, the orange line is the average investment price that you would have gotten during these 5 years. So the average is 3,500, whereas at the end of these 5 years, the market was sitting at about 4,800, and that's why you are seeing a pretty healthy. I think the if you consider the XIRR here, it will come out to be 12 to 13%, which is fairly good, right? Even in a bear market or a flat market, what you would have made had you continued your SIP and would be about 13% of XIRR during this time, right? But it's not easy. Why it's not easy is because during these 5 years, the market is not giving any returns. But if you consider your first year of SIP, even during that time, for the first year, your portfolio would be in losses, a loss of about 11,000. You would have invested about 1.2 lakhs in first year, and your portfolio would be about maybe close to 1.09 lakhs, right? 1 lakh 9,000. So a loss of about 11,000. This is how your portfolio would look at year two. So again here for 2 years, zero returns, right? And it's very hard if markets has not given you returns for 2 years to continue that investment. Many investors would just give away stop their SIP and maybe move to FD. That's what happens usually, and that's what we are seeing also these days. In February, March, the data came out that the overall SIPs now, lot many people now are discontinuing their SIPs in mutual funds, right? And this is how your year 5 would look. So overall, for the first 4 years or so, you are just break even. You haven't really made any returns. It's only when the market has recovered its losses, then you'll see your overall returns, and these returns would be of the order of about 12 to 13% XIRR, which is fairly good. Yeah. Now let's consider if you stop your SIP during the bear market. So a bear market is when the markets have corrected by more than 20%. So whenever the correction is more than 20%, you stop your SIP, you keep on accumulating that 10,000 every month. And when the correction becomes less than 20,000, you put all the SIPs. So let's say for 4 months, the market had a drawdown of more than 20% cumulatively. So for 4 months, you would not be investing any money. And at the end of fifth month, you would put in all 50,000 at one go in the market, right? In this case, your total gain would be 2.26 lakhs, whereas what we saw earlier, your total gain was 2.4 lakhs, right? So here, if you see, the green line would be your average investment price, which is actually higher than if you were not stopping your sale. So this is what usually would happen. And why this has happened is fairly straightforward for you to see, because if you don't stop your SIP when the markets are going down, you are actually able to enter at much lower levels, which is going to help you a lot. Not right now, but when the markets recover, that is the time when you will see your investments that you have made during the market corrections really bear fruit, right? So I would really, if your investment horizon is, let's say, less than 3 years, if you are investing in markets for 1, 2 years, then I would advise you to maybe stop your SIP. But if your investment horizon is longer, 3 years or more, then there is a fairly good chance that market would recover all their losses, and all those who are doing SIP at that point, at this point of time, would be the ones who would be sitting at a very good profit. So for all the longer term investors, the advice is do not stop your SIP, or if you can, do increase your SIPs at this point of time when the markets are in correction, right? So this is the bottom line overall. If you have invested 6.1 lakhs versus intelligent SIP, which I'm talking about, that you actually stop your SIP during bear markets, you'll actually, your gains would be lower than if you do a disciplined SIP. So net, a regular SIP averages out your cost, smoothens the volatility. It is less emotionally taxing, and it does not really need any time at all. There's no pressure on you to really time the market. So it's a fairly simple, straightforward way, fairly easy way. Maybe not emotionally easy, but at when the markets are correcting, but easier than the other method when you are trying to stop your SIP and again trying to time the market and restart your SIP, right? So yeah, that's it from our side. Simran, I think we have received few questions as well.
Yes, Vivek, we can
We
start
can,
answering those. So the
yeah,
first
sure.
question is by Sanjay. As time passes, are the realized profit and loss capitalized, that is reinvested, or are they paid out eventually with rebalances so as to maintain the basic invested amount the same?
So see, if we pay out those profits and we are not reinvesting, then the you would not really get the benefit of compounding, right? So that is not what is happening. What happens is all the profits, they stay in your portfolio, and next time when you rebalance, they are reinvested back. And that is how you actually get the benefit of compounding as well.
The next question is by Ashish Ranjan. Gulaq Gear did very well during its first 3 years, but the last year has been mostly lost in current. For users who started investing in Gear 6 in the last 1 year, what message do you have for them?
So I think I've already shared this. Equity investments, And I say this not only for Gulaq Gear 6, but all your equity investments, whether they are in other small cases or mutual funds, they are meant for longer term. In short term, if the market's correct, you are going to see some losses. These losses might be larger or smaller than the losses in index, right? But for good portfolios, over longer run, you would see decent alpha. Alpha is the outperformance over the index. So if you see anyone who has stuck with us for 3 years or for 5 years, they would have made really good money. So I think this is what one should expect over next 5 years also. So over next 5 years, my expectation would be the 3 years would be really good. I cannot say for sure which 3 years, but this is my expectation that 3 years would be good. 1 year would be average, and 1 year we would again lose money as compared to the index. So I think this was, and this comes from our back tests also, that not every year is a profitable one. Uh, so I think for longer term investors, the message would be that stay patient, keep investing. If you have identified, if you trust a manager that he's doing his job well, then stay patient and keep investing. And this the actual performance, even 1 year is a smaller time frame to judge anyone's performance. That's how equity markets work. That these kind of strategies, even 1 year is a shorter term, shorter duration to judge someone's performance. Again, this is not specifically for Gulaq. I'm talking about equity funds in general.
Hope Ashish, that was a bit reassuring. In case any of our clients feel this way, they can always come to us, talk to us, contact us on our support phone number and email, and we would be happy to, answer these questions and clear any of your doubts or any of the hesitations that you guys are having. The next
I
question.
can tell you if that helps few investors that we obviously our Gulaq team has been investing in our portfolios. I personally have been investing now for many years, and at least I know I have increased my investments when the markets came down and we underperformed. I have actually increased my investments considerably in our strategies.
I believe so have we, Vivek, everyone at Gulaq. The next question is by Manikanta. I started last year, March. Now I am at 10% loss. Also, rebalancing I am doing on the same day after 15 minutes. The market starts, as you suggested. Is it still valid approach for rebalancing?
Yeah, I think that's a pretty good, valid approach for rebalancing. That's what I would say again, that you should continue doing SIP. If you are doing SIP, if you have just not invested at one go, you should just continue these investments. There's fairly good chance. See, nothing can be confirmed. No one can really say for sure that their fund is going to outperform. That no one knows. But we are fairly confident that we are doing, from at least from the last 5 year track record, it says that we have been able to do our job pretty well. And this was always expected that out of 5 years, there would be one and a half, or maybe even 2 years where we underperform. So these kind of performance is always expected.
The next question is by Ashish. I have seen and experienced in most all popular small cases and also in Gulaq that the day rebalancing happens, all portfolios tend to have higher slippage due to leakage or whatsoever the reason may be.
Yeah, so this is something that we have also seen. One thing that we are doing from our side is uh, taking into account how liquid a specific stock is and using that as a feedback loop in our algorithm. So if a specific stock is has very less liquidity, we penalize it a bit. Whereas if this another stock has higher liquidity and the scores are same, then we do take into account liquidity while constructing our portfolio, and that should help our investors at least reduce those slippages that we are seeing. That is one thing. But yeah, slippages, even I have been observing last couple of months, especially the markets have been quite volatile as well. And the slippages have been slightly higher than normal. But we are doing, at least what's in our hands is we do take into account liquidity of a stock while suggesting these stocks. So we do are working on that.
Uh, Next question is also by Ashish. Do you have similar weightage and portfolio construct in PMS, or is it different? So I or any other investor can avoid small cases and invest directly in your PMS. How do you plan on avoiding slippages?
Yeah, so Ashish, the methodology remains the same, but because it's a much larger portfolio, it is much more diversified. So the stocks are different, right? Secondly, because we are uh, in PMS, we do have the mandate to rebalance the portfolios. We do take in we rebalance the portfolios, PMS portfolios, and because we have the, as I spoke about earlier, very good high frequency infrastructure, we do have very good knowledge of the market microstructure. We use that to rebalance our portfolios. So from what I have seen, the expected slippage in a PMS would be, even though the size is higher, the expected slippage in PMS would be far lower than what it is in small case portfolios.
The next question is by Somadatta. I invested in Gear 6 for 1 year, right now in -8%. Same
Yeah.
as shown in Gear 6 1 year performance today. Happy to see that it is almost the same. Hoping this year's performance should get better and portfolio goes in positive.
Yeah, fingers crossed.
Yeah, we're hoping the same. Ajay asks, in the last 1 month, Gulaq Gear 3 seems to have performed the best, followed by 4, 5, and 6. How do you explain this? Does the debt component done better than equity in the last 1 month?
So I think one of the thing has happened in last 1 month was our original investments. The debt component was in Bharat Bond 2025, which got expired mid of month, and the money was redeemed in investors' bank accounts. And we introduced Bharat Bond 2030 at the end of the month. So there was a time frame of about maybe 15 days where Bharat Bond was not included, and during that time also markets spiked up, and that's why you see your returns have been higher than what they normally are. I think that is the reason. Otherwise, also, I think year three, all those who have been holding debt and equity in that proportion has done well, because debt usually is not that volatile, but equities have done fairly well last 1 month, and that's why all our portfolios have beaten the benchmark.
The next question is by Shiva. Hi, Gulaq. The Google Calendar invite for webinar was for 6 p.m. today. Did it get preponed?
Yeah,
Yeah,
we actually, yeah, go ahead, Simran, please.
we did prepone it in light of what is happening right now, the drills and all. That's why we preponed it. But we did send out a communication to all our users regarding this webinar. And in case you were not able to attend it from the start, this would be put on our YouTube channel later as well. So please feel free to revisit this video and have a full look at the entire update if you want. So this was the last question. We'll just wait for a couple of more minutes in case any of our investors or users want to post any more questions. We'd
Sure.
be happy to hear from you all. If you have any feedback for us or just any questions, any suggestions, just please put it on the chat. Somadita Das asks, is Gear 6 performance, the performance that we have shown, does it include the fees?
No, that the performance on the website on small case platform, it does not include the fees. It does not include the brokerages and other charges. Yeah. So there's going to be some loss. What we are showing about 20% outperformance year on year, annualized over last 5 years. I think there's some leakage maybe of about, I would say, it depends on your brokerage also. It depends on when you are rebalancing your portfolios, but about 3 to 4% slippage annualized, I would see, I think would be there.
Any more questions from the users? We are waiting in case you have anything else to ask us. So I think we can wrap it up, Vivek. Thank you so much, everyone, for joining in. Hope you have a good day.
Thank you, Simran. Thank you, everyone.